Randy, just give me your take on what you heard from Chair Powell.
I think you guys are focused on exactly the right issues. What is the message that he wants to give? We're going to fight inflation, and we're going to keep at it, even if the economy slows. He talked about how it may be some time that they will need to keep rates in a restrictive area. He talked about a sustained period of below trend growth, which of course could include a recession. He really wanted to try to get the markets to believe that they're going to raise rates, get to around 4% or so, plus or minus 25, 50 basis points, and they're going to keep them there.
All right. Did it deviate at all from what your expectations were going into to the speech?
It was spot on, because I think since the last Fed meeting, you've had every single Fed speaker, including people like Neil Kashkari, who had been super doves before, all saying exactly the same thing. We're going to keep at it, and we're going to keep rates up. And I think he really wants to get that message across. And I think he tried to do that. And whether the markets are listening, I'm not so sure, because we haven't really seen much movement in the 10-year. I think they're still not buying it.
You think, Randy, that the markets are not buying the Fed's intent, or they simply think that circumstances are in the process of changing? In other words, some of the leading indicators of where inflation is going to track from here might, in fact, give a tailwind to them getting to neutral and not having to do a lot more.
I mean, inflation is so far above their 2% goal that this is not something that's going to come down in 3 or 4 months. This is something that's going to take another year. He said they need to feel confident that inflation is actually down. And it wasn't by accident that he invoked Paul Volcker and the mistake that had been made just before Volcker got into office, that the Fed pivoted too early. He was underscoring that. It wasn't random that he quoted Paul Volcker.
But Randy, how much collateral damage do you think that the Fed could tolerate? I mean, he was pretty resolute in his speech today, saying basically price stability is the most important thing in the economy, and the pain would be a lot worse if we don't get this under control. But is there a risk that there are some sort of exogenous events out there, for example, that do, in fact, create even more pain that would cause a pivot or, something different than what we heard from him today?
Well, certainly, Mr. Putin could do things that really upend the global economy. So putting that aside, I think they're really resolute on that. I mean, if there's some sort of extreme escalation in the conflict, and also we have other areas of potential conflict in Asia and the Middle East. So obviously those could upend things, but I think except for that, if just the unemployment rate starts to move up, they're going to tolerate that.
How much are they going to tolerate?
Of course, that's the magic question. Now, fortunately, they're starting at 50-year record lows of the unemployment rate. That's very different than where Volcker started things. So the unemployment rate can go up quite significantly and still not be in extreme bad territory. So let's say the unemployment rate gets to 5 to 6%, dramatically above where it is now. But, by historical standards, not really that high. That's my guess is they'd be willing to tolerate something like that. But they don't have a number in mind. They're really going to see how the economy is moving.
Right. Randy, thanks for your insight. Have a great weekend.